Because the FDIC, let's just talk about what that is, because it's kind of a joke. If I'm candid, And by the way, Susie Orman is such a sellout. In 2008, she was doing commercials for the FDIC to say, "Don't be worried." I'm like, the FDIC didn't even cover 10% of the issue.
Yeah.
So every bank has to put an insurance premium into the FDIC. Right. And they had like $123 billion in FDIC insurance in 2022. And like 3 banks took out $36 billion of it. 3 banks.
Right.
So when we go back to 2008, the estimate is the government came up with $5.5 trillion above the FDIC to bail the banks out.
Yeah.
So it's the FDIC is more like a warm, fuzzy, make you feel good, but they don't actually have adequate capital to handle the problem.
Yeah, and that's exactly what's going to happen. If there was, I'm not predicting that there is, but if there was a second coming of the Great Depression, and the banks all over the place are failing, like, guess what? The Fed's printing money. That's the only possible way.
That's the way that they get through it. And for them to print money, ironically, lowers the value of the existing government debt of 34 trillion.
Inflation is the insidious tax on the poor. That's how you actually, the only way we're out of our national debt crisis right now. You can't tax your way out of it. We are mathematically way beyond the ability to do that.
If we tax people at 100%,
right,
we don't have enough to cover it.
Right.
What is it, like $228,000 per taxpayer?
I think it's higher than that now.
Higher than that now? I mean, it's some astronomical number, right?
So it's I mean,
which I wish I could just pay that now, and then I'm never I'm not part of that debt. But then they're just going to keep printing money, because every time they do, they can spend and then justify it through printing, because that waters down everybody's money. Like when they collect taxes, that's an actual process,
right,
where people see money leave their account, even if it's just out of their paycheck, automatically happening. When they do a stealth tax of inflation, you don't see it leave your account. You just can't buy as much.
Right.
And that's why you call it insidious.
Yeah.
And unnecessary. There's people that believe that inflation's actually necessary. It's not. If we remove the printing of money, then we still have what's called the velocity of money on our side. The velocity of money says, even if there's a limited amount of money, there's an unlimited number of times it can exchange hands.
Right.
So if we start thinking of money as so limited and finite of, there's only this number of dollars, well, how many times can that dollar circulate in a given year?
Right.
We're not just holding on to money and setting it in a couch cushion. It's going in the banking system. And this is the second part of inflation, is when it hits the banking system, it's lent out 6, 7, 8, 9, 10 times on the same dollar, which creates inflation.
Yep.
So we have government spending, we have fractionalized banking, and then we have, the printing of money, which doesn't actually get printed most of the time. We call it printing of money,
right?
But it's just numbers added to the balance sheet. It's banks. It's all this closed system, right? Centralized banking. We don't see the transactions. It's all happening in a bubble that you can't see as a public.
Right.
And they could just say, there's more available now.
Well, and that's why there's such Fed activity during, economic hardship. When that velocity of money dries up, people don't want to make investments, and that stops exchanging hands. That's when the presses begin. We just saw this, multiple times in the last 20 years through 2 major collapses.
Right. Well, that's the frightening thing about when interest rates get so low. How does capitalism work if when you allocate your money, you get less than a 0% return? Because remember when the inverted yield for a while, where there was, if in like 2009, if you wanted to get a return, you couldn't,
right,
because of what was happening. Or we saw that during COVID, like where were people storing their money? There were certain treasuries that were not paying interest,
right. Yeah,
so
there's parts of the world where it was negative interest,
right? Negative interest.
You're paying that,
right, because you're like scared that you're going to lose it if you keep it in cash. So, so the negative interest was a slower leak, which is crazy. Because ultimately what we're doing is saying, hey, look, I've got an idea, and if you have money, you can help me fund this idea, and I can return that money with an interest because of what I can create, but I need the infrastructure. And by the way, like, not to go too far down this rabbit hole, but this is why I'm not a believer in the stock market anymore. Like, I'm just going to go on record and say, I think the stock market was a brilliant invention for companies that needed to raise capital because their ideas were bigger than their pocketbooks. Yep. And they needed infrastructure. I always like to think of the example of like when FedEx was like, we're going to get things overnight anywhere in the world. Okay, that requires a lot of infrastructure. You can't just have one person with an idea and their own money to fund that necessarily. So to be able to, issue a stock that brings in capital so you could build it out and the stockholders could benefit from that, great. But guess what? In today's world, no one does that. Private capital does all of that.
Right.
Very wealthy people have private capital deals that probably double their return over what the stock market could ever do. Mm-hmm. It funds these private companies. And when they finally go public, it's for one reason: for the owners to exit and get a boatload of money.
Right.
And when I say owners, mostly the value extractors at Wall Street that are now the venture capitalists that are involved in the deal.
Exactly right.
Not as much the entrepreneur that invented the company. So I don't love the stock market because of that. And it's secondary market most of the time, which means it's all perceived value. And so we're just buying something on perceived value. But most people don't know what they're buying. They've never looked at it. They just automatically put money in it. They're not thinking about it. And I just know people with public companies that sold. And when they sold, and these are major public companies, they don't have $1 of that stock because they're like, it's so overvalued. There's no way that company is worth that. It's only worth that because of retirement plans and people not thinking about it.
It's true. It's true.
And another reason I like cash value, because they're in long-term bonds versus just stocks.
Yeah, well, at the end of the day, why the cash value is there. The cash value is the reserve of the company. When they hold these big general investment accounts, the reason they're so high, all these companies are so highly rated, is because the instruments that they have to own inside these general investment accounts to get those ratings are the safest, most secure.
What's the highest percentage of stocks they could hold?
I don't know the answer to that. I mean, some of them, if they own stocks, it's usually through wholly owned subsidiaries. Like they'll own an investment company, or they'll own another life insurer, or an annuity division, or something like that.
So it's a way for them to acquire a company, not to play the stock market.
Yeah, they're not speculating.
They're not in stock. Tesla.
Yeah, it's usually companies they control. As a subsidiary.
Kind of how Buffett does.
Yeah, exactly.
Like Buffett's not really a stock market investor. He acquires companies through the stock market.
Yeah. But again, these accounts are all about yield. They're investing conservatively to meet the guarantees down the road that they're making 30, 40, 60 years down the road via those death benefits, which is the guaranteed ultimate gain. So they need that capital to be very stable and predictable. But any investment that they make, anything inside that portfolio, is all income driven. So that's why they invest in bonds, because it provides income. If they own equities or they own subsidiaries, they want the cash flow from those businesses, because that cash flow is what provides the dividend to the policy owners. That's the whole charter of these companies, is to operate for the benefit of the policy owners, not some shareholder or Wall Street exec that's trying to.
So let's talk about participating mutual companies to specifically address that.
It's the only form of permanent life insurance I would ever buy, is a dividend-paying, participating life insurance policy from one of the big mutuals. And
participating versus non-participating, break that down.
What participating means is you participate in the profitability of the company. So the insurer will issue a $1 million policy to a policy owner. They will guarantee that $1 million pays out someday when they die, not if they die. So they're now on the hook to pay that out, and they have their actuarial tables, and they know what's going to happen in 51 years on average, or whatever. Then it's on them to make sure that they collect enough dollars so that they know when they have to pay that claim, on average, 51 years down the road, or whenever that comes, that they have that much money in their hands to pay those claims. So the way they do it and the way they orchestrate it, and this almost sounds bad, but they effectively overcharge their clients on purpose when they issue these contracts. And that sounds terrible to people, because what they do is, when they issue these contracts, they remove all risk from the client. They assume worst case mortality, lots of people dying. They assume worst case expenses, things like regulatory environments, and it's very expensive to keep these policies going. And then they assume worst case interest rates. Like, what do we think is the worst case scenario that we can earn on our money to make sure that it grows to these guarantees we've put in place? And then what happens every year is, they manage the mortality. They medically underwrite, and they manage that down. And the expenses, as efficiencies take hold and they employ technology, they manage the expenses. But the biggest one of all over time is the interest. They invest very strategically for the long run, very conservatively, and they may guarantee these policies at 2 to 4%, but they're typically getting 5 or 6 now. Over the last 40 years, it's been closer to 8% for these big mutuals. So all of that excess profitability, essentially, that overcharging that they didn't need to overcharge you, there's no shareholders to get that. Like, they can use some of that performance to make other investments, acquire other companies, other financial advisor sets. But at the end of the day, it's got to go back to the policy owners for whom they serve. There are no other interested parties. And that's the perfect alignment that I have with my insurance company that I would want them to have, where they're serving my long-term interests in lockstep.
Right. So participating mutual companies. So it's not on the stock market. A mutual company is mutual versus stock, right? Mutually, and then you're the policyholder, so you're basically participating in the benefits of the company.
Yep.
I wouldn't own any stock company policies either.
Yeah, I mean, they
unless it was like wholly owned by a mutual company, maybe.
Maybe, but then again, you got shareholders. There's examples of these big mutuals who have demutualized, and they've effectively
Ohio National.
There's a number of examples over the years, and some of them. So there's actually some whole life companies that were always kind of stock companies, and they've kind of gotten away from the whole life business because, look, if you think about like a capitalist, if
they're not getting the margins they needed to get.
No, a true equity based capitalist is going to want 20-30% returns on their money, and
there's no way to do it here.
Yeah, you can't. No, this is safe, conservative stuff, and that's good. We need that. I jokingly say any prudent portfolio, no matter what your risk tolerance is or what your proclivity is, should have some component of that portfolio which is stable, fixed, guaranteed, accessible at any time. Boring. You need a boring component of your portfolio in order to do those other things. And whole life, for a variety of reasons in today's market, is the best boring money can buy. And I think it's the best time in about 80 years economically to own it moving forward.
Well, then let's talk about this. So there's this book that I've written, Becoming Your Own Banker. Infinite banking concept. I first want to say infinite is a word I have a problem with.
Yeah.
It's not infinite. Banking is something I don't want banking. Banking has been problematic. An alternative to banking, sure. Okay. But it's not banking. And concept, I think we need something stronger than concept. But these people that are feeling like they need to immediately borrow their cash value and immediately get into other investments. What are those investments? And what about these people that are borrowing cash value to buy more policies? I want you to break that down in your philosophy.
It's a good question.
Not that I'm leading, and you already know what my opinion is.
Well, I think originally, or maybe not originally, but the concept behind infinite banking is basically overfund a whole life policy, get lots of cash value up front, and now you don't need the banks. Honestly, it's not that different than just building a big savings account and then using that savings account. The difference is inside of a life insurance contract, that underlying policy continues to grow. You still get death benefits. There may be interest rate arbitrage for a moment, but that tends to level out over time. But that's the whole concept. So I think some people have taken it to an extreme where they're going to hyperfund this thing for a year or two, then suck all the capital out. And what you're doing there is you're negating the thought that you need savings. Like you no longer have savings now. You've just taken that and put it in a risk asset. And there is a loan against the contract that needs to get put back. That said, don't get me wrong. I mean, I've owned a whole life for most of my life. My biggest policy, which is 15 years old, I've used to fund the purchase of 3 houses and a business. Yep. I use it almost
I bought this cabin we're sitting at with my cash value.
Yeah. So money goes in and out. I'm always repaying loans, taking them back out. So that is my source of capital. But that's what it should be for, is an opportunity fund and opportunistic things versus just
groceries,
financial engineering, or whatever people are trying to do.
Borrowing and paying it back and borrowing for everything.
Right.
And I just want to say, be careful what you're investing this in, because if this is allocation that's basically replacing your bond portfolio, and now you're taking and putting it at risk because you're investing in something you don't understand, you're putting that cash value at risk.
Yeah.
So I've done a lot, built a TV studio with my cash value, paid off a high interest rate American Express that I then paid back to my cash value. I bought a business with it. I did a full development. I bought something out of bankruptcy and put a fourplex on it, on this land. I mean, I've used it a lot, but I also used it to do a project where I just lost money on it. It was basically this NFT that I would get direct access to Steve Aoki. And then his team was like, we're not going to continue that for a lifetime, like we said, which lost the value of that asset. So it's that was highly speculative. And that was something that was, I should have never used cash value for.
Yeah.
That's cash that's in a speculation account. So most of the time it's turned out really well for me to use cash value, other than when I had to just use it to bridge to the other side of having overextension in real estate in 2008. A lot of my cash value deals have done really well, but I also had periods of time where I didn't use it.
Right.
Because I just felt comfortable and I was focusing on something else and didn't need cash for what I was focusing on because it was profitable from day one. So it's just, I think people need to be a little bit careful what they're using it for, because we're talking about how solid these portfolios are for these mutual participating companies, and then saying it's an opportunity fund.
Well, think about just a traditional asset that everybody owns, or most successful people own, like their house, like their primary residence. It doesn't matter how big the house is, but let's say you got some substantial equity in it. Would you ever borrow up to every single dollar that the bank would give you to then take those dollars and invest in something speculative?
I mean, people did in 2008, and they lost most of it.
Right. But
right.
That's the
so
same
we watched that. Yeah.
So if you have an appetite for that kind of stability in your portfolio, something that you can just kind of rest your head at night about, that you know is going to be there, then why would you sign up for a strategy where you're then going to max leverage it to do something else? It makes sense opportunistically along the way, but there's a value to have that there.
I take like 15% of every dollar earned and put it into my cash value, into my policies. Sometimes a little bit more than that, but yeah, that's like my minimum.
As you should.
Because I need to battle future tax hikes and future inflation and technological change as I'm buying new things I didn't never buy in the past, right? And I want to battle my propensity to consume by having cash in the future to be able to have more luxuries, because they all feel like necessities after enjoying them for a little while, and just things break down, have to be replaced. So that's my 15% thought, 3% for each of those factors.
Right.
That's the minimum off the top. And I don't really have to budget if I'm doing that off the top. Then I can live off whatever's left.
Yeah.
And then I've used my cash to build other assets.
Right.
And so that's a pretty simple plan that works very effectively.
Right. But that access is so key.
Yeah.
The fact that you have access to it along the way. You could put your money into a retirement account, but then you're not going to see that until...
Guess how much money I have in retirement accounts?
$0. Why am I not surprised?
So I started Guardian Life when I was 19 years old, June of 98. And they matched, I think, like 3% or 6%, whatever it was. It might have been put in 6, get 3.
Yeah.
I did it. And then when they wouldn't allow me to speak at other Guardian events while I was at FR, field representative for them, and they wanted me to get a Series 7. I was only Series 6 and 63, and I just passed to 65, but I didn't want to become an RIA. I left, and then I just cashed out the 401k and put it in a yard. And I was like, cool, I could just look at it every day. I took the 10% penalty, and I never looked back.
Yeah.
I don't have any money in Roth. I don't have any money in a government qualified plan where they can just, with a stroke of a pen, make a change that easy. It's just not for me.
Yeah.
I'm about cash flow. I'm about a little bit of control.
That makes sense.
And I like cash value. My wife feels comfortable that we have a certain amount in there. With that amount in savings, we feel like we have a good foundation. It means I could be, if I'm going to be speculative, it's in my own intellectual property and in my own businesses. And that's a really solid foundation, knowing how it's invested by the insurance companies, knowing it's something I can count on. It brings that peace of mind and that financial confidence, so I could be more productive.
Yeah. And you think about the lifetime yield that you get on a life insurance, but go all the way out, all the way out to your death when it finally pays that death claim, which is a certainty that will happen.
Yeah.
If you live
living death or death, right?
Living, yeah.
They'll either go, you made it, we're giving you the money for your last few years of life when you hit 100 or 120, depending on the policy. But
exactly, it's coming.
Or you die.
But when you map that out over time, your reasonable expected rate of return is going to be probably 6 to 8% over the course of your life. When that finally completes and that finally pays out. If you live a long time, if you die young, it's a really nice return, but not for you.
Yeah.
But
you don't want to get the early return.
But when you adjust for what you need to earn in a taxable world to get 6%, now it's at a 1/3 tax rate. Now you're at 9%, and then you add in investment management fees, and now you got to get 10 or 11. And there's some other costs you can factor in there too, like the cost of owning term insurance. So where over the course of your life are you going to get a relatively predictable, 10, 11% taxable equivalent yield without taking a ton of risk and exposing yourself to 2008s when you lose half your money?
Yeah.
It's actually a better deal than people think. You're going to do pretty well in these over time. And you don't have to take tons of risk. I think there's so much FOMO that goes on there right now because everyone just reads headlines about NFTs and crypto and they see the stock market just keep going up and the buy the dip mentality and all that stuff. Like, I think a lot of people have way more risk than they really are comfortable with. And we saw a lot of that in 2022 when the bonds were going down, stocks were going down, and people were kind of freaking out saying, wait a minute, everything's going down. I didn't realize quite as much as I should have how much risk is on the table.
Right. All right. You heard it. So stabilization,